Bill, maybe let's move on and let's talk about an overview of kind of the sell side process, just to give our audience kind of an understanding of that. I mean, you wrote a book around this. Please tell us the phases of the sell side process. I see it as kind of preparation, marketing, negotiation, closing, but maybe you can give us kind of an overview of all the phases within a sell side process.
Sure. I divide this down into it's a 12-step process, John, and this variations might exist out there, and we can do things slightly different. But the general gist is, we get retained to sell a business. We put a buyer's list together, or target list, potential investors or buyers, and that's collaboration with the owner of the company. Quite often they'll have a short list of people who have reached out to them, or groups they think might be interested in buying them. We will put the teaser together, which is the first entree that buyers quite often look at a business. It's usually no names on it. It's anonymous. We will put a confidential offering memorandum together, or SIM. We make contact. That's a combination of making phone calls and emails. We get the teaser out. We secure confidentiality by getting an NDA signed. The first step after those materials go out to the potential buyers is we ask for an indication of interest with a range of value. Based on those indications of interest, we'll set up management meetings with suitable parties. We'll ask for a letter of intent. There's always negotiation going on there. When we sign a letter of intent with the one buyer that we've decided to do a deal with, we go into due diligence and purchase agreement drafting. I'm skipping over a lot of the details, of course. And then once all the due diligence is done and the purchase agreement is done, you have the closing. And then the big aspect that is glossed over and completely missed by people who do what I do, which is probably the most important thing for the buyer, is the post-closing adjustments and the integration. It's difficult for us just selling a business, because once that deal is done, we are gone. But that is a very, very key aspect of doing a transaction as well.
Yeah, I'd agree with you there. And I try to stick around long enough to help them, at least with the initial working capital adjustment, and then, obviously available for any future, things that are within a purchase and sale agreement that need my expertise. Michael, anything you'd like to add to that process, or kind of elaborate on?
Yeah, so I'll elaborate on one and add one. The elaboration would be on just say building up a data room, preparing the company for the excruciating due diligence that they've never seen before. So a lot of them say, well, I already have an audit. Well, the audit is like probably 2% of what needs to be done. So that compiling that data room is putting all the key documents in an electronic data room. You don't necessarily show it to everybody, but you're going to show a certain layer to the initial people, then a second layer to the finalist, and then the last layer is for the final due diligence. It's extraordinarily important to have that done prior to all this process. The last thing you want to do is take 30, 60 days to compile it. In some cases, our clients just simply aren't prepared, and so you want to make sure that gets done ahead of time. And I'm talking about that could take anywhere from, it could take 2 months, it could take 6 months to get some of the things done, especially if there's scary things like environmental issues or litigation outstanding. The one addition I would add is in our firm, I'm going to almost always require a quality of earnings report done by a third party. This is typically a quality of earnings firm, an accounting firm, someone like that. And they're validating the numbers, and we can get into that, but they're putting a report together that's now a lot of buyers used to do. And so when we would put an auction together, come up with our number, then they would hire a quality of earnings firm, and the buyer would, and all of a sudden our price that we thought we sold the company for is now discounted 5% because of what they found. So now what sellers are doing is doing this proactively. Yes, it's on their dime, but what we have is much less trading going on at the end, because this third party that's independent of us is coming up with a support for the financials. And so that would be something, at least in our firm, I would add to Bill's list.
Yeah, Michael, I completely agree that the Q of E, I think sometimes it's a difficult thing to convince the seller that they're going to spend. It's not going to be inexpensive, but they could spend, I don't want to price it for an accountant, but 50, 75,000, depends, maybe more. I think it is worth every penny that they will spend on a QOV, because that will help maintain and hold on to the value. Whatever they're spending, it is going to be well worth it, and then some, when the final reckoning comes at the closing.
I think that preparation does a few things. I think it alleviates any surprises, not only for a potential buyer, but also for us as investment bankers that might arise, and then also just gives a lot of confidence to prospective buyers that they have this independent view on the level of earnings within the business, and just the ability to deliver information at a high quality, that's a quick turnaround. I think all of that really effectively moves the process along and just creates this confidence. Simon, anything you want to add on the sell side process overview, the preparation of documents, and then also another question I want to pose to you is just the timing of the sell side process. How long does it typically take from start to finish of an engagement? And I know that depends on a lot of factors, but maybe let's speak to that.
Sure. I guess the things to add from my perspective. Preparation. I mean, it's all about, if you want to run a good, tight process, it's about doing all the preparation up front, and that could take 6 months. We're hoping to close a transaction in the next few weeks, and we only started it at the end of September. But we didn't really start at the end of September, we started it at the beginning of the year. And we've done all that preparation, working with the company, working with them on acquisitions, working with them in terms of preparing the business, doing a data book, which then feeds into the vendor due diligence, the quality of earnings review, feeds into the commercial due diligence, and we've had everything ready, the legal agreement, the legal due diligence, so that when we decided to go to market at the end of September, we're actually, then even with that quick time process, we were looking to close sometime in November, but we had a preemptive bid, and now we're working towards that and closing it end of October. Now that is super fast, but it could only be possible because all the preparation that went on before that. And we would tend to see quality earning reviews in the UK, probably on deals, at around 25, 30 million sterling. And upwards. I'm doing it on one at the moment that's probably only a $10 million deal, but we're doing all the preparation. We've done the SPA, and that all feeds into the information memorandum and helping you have consistency of messaging. And we're hoping to run a quick process. But even so, in terms of asking how long the process could be, we're looking to complete that deal in February, even though we've already, got ahead of ourselves, done the vendor DD, quality of earnings, and having done the legal reports. We're still going out to market, but engaging with buyers and trade strategic buyers takes time, especially if they're overseas buyers as well. And you want to make sure that the business is properly exposed to the buyer population. So it just does take a bit of time to engage and then run up to hopefully a quick completion.